Welcome to the deep dive. If you've ever tried to do anything major financially, like buying a car, getting insurance, even just renting an apartment, you've probably run into this mysterious three-digit number. It feels like it holds this immense power over everything. We're talking, of course, about the credit score.
It really is, isn't it? The ultimate gatekeeper sometimes. And the weird thing is, for something so critical, how it actually works often feels like a black box. And for millions, maybe people with lower scores or no score at all, it's meant being locked out of basic financial stuff, pushed towards really, really expensive options instead.
That's exactly the knot we want to untangle today. This deep dive, it's got two main goals. First, we're going to pull back the curtain, really demystify the mechanics of the big scoring models, FICO and Managed Score, what actually goes into them.
Get the recipe, basically.
Exactly, the recipe. And second, and this is where it gets really interesting, I think we're going to map out this huge shift that's happening right now, a really positive one for consumers. It's this boom in safe, affordable, small dollar loans, stuff that's now open, even if your credit history is, let's say, thin or not great.
Yeah, and for this, we're leaning on some solid research. Think tanks like Pew Charitable Trusts, plus info straight from the credit bureaus, and the regulators, the CFPB, the FDIC, those folks, they all seem to confirm that things are actually changing in a pretty significant way. So, yeah, let's dig in.
Okay, let's start right at the beginning. The score itself, it's that three-digit number, usually runs from, 300 up to 850?
That's the typical range, yeah. And its whole purpose really is for lenders to predict risk. Specifically, how likely are you statistically to miss a payment badly enough to default in the next, say, 24 months?
Got it. Risk prediction. And there are two main players doing this prediction, right?
That's right. You've got FICO, which is the older, more established one. Over 90% of top lenders still use some version of FICO, especially for big things like mortgages. And there's Vantage Score. That one was actually created by the three big credit bureaus working together. Equifax, Experian, and TransUnion, kind of their own model.
Okay, so two models, but they use the same underlying data from our credit reports.
Exactly the same data. But, and this is key, they weigh things differently. They have slightly different recipes. So you might see a score that FICO calls good, say 670 to 739, but Vantage Score might call that same history good, or prime, across a wider band, maybe 661 up to 780.
Huh. So which score you see really matters for how you feel about your credit health. It's not quite standardized.
It can definitely be confusing for people. But since FICO is still so dominant in lending decisions, it makes sense to focus on their recipe. Let's break down those 5 FICO factors. Think of it like a pie chart making up 100% of the score.
Okay, the biggest slice, the most critical piece, sounds like.
Absolutely. Payment history, that's a huge 35% chunk. It's simple, but crucial. Pay your bills on time. The research is really clear. Just one payment that's 30 days late can seriously tank your score. Disproportionately so.
35%. Okay, what's next biggest?
Right behind it, at 30%, is what's called debt burden, or more commonly, credit utilization. This is basically how much you owe compared to your total credit limits. You always hear that rule of thumb.
Keep it under 30%.
Yeah, keep it under 30%. But honestly, that's just the baseline. If you're aiming for those really high scores, the 800s,
You need to be lower.
much lower. The data suggests aiming for under 10% utilization is better. And here's a practical tip we found. If you use your card a lot during the month, try paying down the balance before the statement closing date, not just by the due date.
So the reported balance is lower. That affects the utilization calculation they see.
Precisely. It maximizes your score potential in that 30% slice. It's a bit tactical.
Okay, so payment history 35, utilization 30. That's 65% already. What else?
Next up is length of credit history. That accounts for 15%. It looks at how old your oldest account is and the average age of all your accounts. This is why people say, don't close that old credit card you never use, even if it has no fee. Keeping it open helps this factor.
Right, the age matters. Okay, 15%. That leaves 20%.
Yep, split into two 10% chunks. First is credit mix. Lenders like to see you can handle different types of credit responsibly. So, like having both revolving credit cards and installment loans, maybe a car loan or a mortgage.
Shows versatility, I guess. And the last 10%.
That's new credit, or sometimes called inquiries. Every time you apply for credit, it triggers a hard inquiry. Too many of those in a short period can make you look risky, so it causes a small, temporary dip in your score.
But what about shopping around for, say, a mortgage? Doesn't that hurt you?
Good point. The scoring models are actually smart about that. If you're rate shopping for a mortgage or an auto loan, multiple inquiries within a short window, like 14 days, Sometimes up to 45 are usually grouped together and counted as just one inquiry. So you're not penalized for comparison shopping.
Okay, that's good to know. Before we move on, let's just quickly recap what doesn't count, because there's a lot of myth out there. Your income.
Nope, not directly in the score calculation. Your employer, marital status, race, ethnicity.
None of that. It's legally prohibited. The score is designed only to look at your past borrowing behavior.
Exactly. It's purely backward looking. How have you handled debt in the past? And that very specific focus, that refusal to look at, say, current income or savings, that's actually what creates problems for a lot of perfectly reliable people.
Right. And that problem, that systemic exclusion, brings us perfectly to the next big point. This is where the story really starts to change. For years, if you were, say, young, just starting out, maybe new to the country, if you didn't have that established FICO score, getting a small loan from a bank for an emergency, forget it.
Totally. And that pushed millions of people, often needing just a few $100, towards really predatory options. You know, the payday lenders, the auto title loan places, those things have insane interest rates, APRs in the triple digits, 300%, 400% sometimes. They trap people. Americans spend something like $20 billion a year just on fees and interest for those types of loans. It's staggering.
20 billion, just because they couldn't access regular banking products. But you said this is changing. What's the shift?
Okay, so here's the watershed moment. According to the research, starting around 2018 or so, we've seen this really rapid growth in banks and credit unions stepping up. They're now offering safe, affordable, small installment loans and lines of credit. We're talking big players. 6 of the top 8 largest banks in the U.S. now offer these products.
Wow, okay. So how much cheaper are we talking?
The difference is night and day. Let's use an example from the Pew Research, borrowing $500 for 4 months. With a typical payday loan, you might end up paying $500 or more in fees, just fees. With one of these new bank small dollar loans, you'd pay maybe $35 or less.
$35 versus $500.
Yeah, it makes the bank loan something like 15 times less expensive. That's billions potentially staying in consumers' pockets instead of going to high-cost lenders.
That's incredible. What allowed this to happen? Why did the big banks suddenly jump in?
It really boils down to the regulators giving clearer guidance. In May 2020, several federal agencies, FDIC, OCC, the Fed, NCUA, jointly issued stable, clear guidelines. This basically lowered the perceived regulatory risk for the banks. They felt more confident that they wouldn't get penalized later for offering these loans. It gave them the green light to scale up.
Okay, regulatory certainty. But how are they lending safely if they aren't relying on a high FICO score? That seems like the magic trick here.
It is the key innovation. They're largely bypassing the traditional credit report. Instead, the underwriting, the decision-making, is based mostly on the customer's internal account history and cash flow data.
So they look at your checking account activity.
Pretty much. They ask, does this person have regular deposits, like a paycheck?
Yeah.
Do they manage their account well, avoid lots of overdrafts? It's a much more real-time, forward-looking picture of someone's financial stability than an old credit report provides.
So it's less about your history borrowing from others and more about how you handle your own money right now.
Exactly. And the great thing is the main requirement is just having a checking account, which something like 95.5% of U.S. households already do. It's much more inclusive.
Right. So what makes these loans work well for borrowers? Are there specific features?
Yeah, Pew Charitable Trusts actually updated their standards based on these successful programs. They pinpointed 4 key things. 1, access. They should be available to existing bank customers who actually need help and seem able to repay based on that cash flow data. 2, affordability. The loan needs to give you enough time to repay, at least 3 months, and the payments shouldn't eat up a huge chunk of your income.
Okay. Access and affordability. Makes sense.
3, fair pricing. We're talking reasonable APRs, maybe mid-double digits, 36% or lower, not 300%. And 4, speed. The application process needs to be quick, often using online or mobile banking, and you should get the funds the same day if approved. It's designed for immediate needs.
Fast, fair, affordable, accessible. Got it. That structure sounds much better for the borrower. This move towards using cash flow is fantastic news for people who are kind of shut out by the old system. But what about folks who need to build a credit score from square one or repair a damaged one?
That's where the traditional credit building products still play a really important role. The research highlights 2 main types of secured products.
Secured, meaning you put up some collateral.
Exactly. The first is the secured credit card. You give the bank a cash deposit, maybe a few $100s. The median is around $325, so pretty low. That deposit becomes your credit limit, or close to it. Then you use the card like normal, make payments, and crucially, that payment activity gets reported to the credit bureaus. Builds history.
Okay, secured card. What's the second one?
The other main one is the secured small dollar loan, sometimes called a credit builder loan or a passbook loan. This one's a bit clever. You apply for a small loan, say $500 or $1,000. The bank approves it, but they don't give you the cash right away. They put it into a locked savings account or a CD for you.
So you don't actually get the money up front.
Not upfront. You then make regular monthly payments on the loan. Once you've paid the loan off completely, the bank releases the original $500 or $1,000 from that locked account back to you, plus maybe a little interest. The whole point is just to generate a positive payment history on your credit report. The bank has zero risk because the loan amount was secured the whole time.
Ah, I see. It's purely a mechanism to demonstrate repayment ability. That's smart.
Yeah, it works well. And, we found this interesting data point from Illinois from their Secure Choice Retirement Savings Program. It sort of illustrates how any consistent financial responsibility helps. They looked at people who were auto-enrolled in this savings plan, those who started with pretty low FICO scores, around 609 on average.
Okay.
After just 1 year of consistently saving through this program, their average FICO score went up by over 18 points.
18 points just from saving.
Yeah, and that was significantly higher than the average score increase for the general population in Illinois during the same time, which was about 11 points.
Wow. So it's not just about debt repayment. The models or maybe the underlying data somehow pick up on general financial stability even from saving.
That seems to be the implication. Consistent positive financial behavior, whether it's saving or paying bills, correlates strongly with what the credit scoring models are trying to measure, which is ultimately responsibility and lower risk. The behavior is the signal.
Fascinating. But okay, the score is only as good as the data behind it, right? We have to talk about errors.
Absolutely critical point. Credit reports are notoriously prone to errors. And your reports can look different across the three main bureaus: Equifax, Experian, TransUnion.
Why is that?
Well, not all lenders report your account information to all three bureaus. Some might only report to one or two. Plus, simple data entry mistakes happen, or errors in matching files, especially if you have a common name or if your name or address has changed.
So what can you do about it?
You have a legal right to dispute any inaccurate information you find on your credit reports, and you absolutely should exercise that right. There was a study back in 2012, a decent sample size. It found that 61% of people who filed a dispute ended up getting some modification to their report data. And for 13%, the disputed item was deleted entirely.
So disputing actually works a lot of time. It can make a real difference, especially to that huge 35% payment history factor.
Definitely, which is why monitoring your reports is so important. And the good news here is it's free and pretty easy now.
Right, annualcreditreport.com.
Yep, that's the official site. You can actually check your reports from all three bureaus for free every week now if you want. And crucially, checking your own report is considered a soft inquiry. It does not hurt your credit score at all. So there's no downside to checking regularly. Hashtag tag outro.
Okay, so let's try to pull this all together. We started with the kind of strict backward-looking rules of traditional credit scores, FICO and Vantage Score. Payment history and how much debt you carry, utilization, those are really paramount.
Right, the big chunks of the pie. But then we saw this really exciting shift, driven largely by clearer rules from regulators around 2020. It opened the door for banks to offer these new, safe, small-dollar loans that are dramatically cheaper. Remember, like 15 times cheaper than payday loans. A huge win for consumers.
And the key was how they're doing it safely by looking less at the old FICO score and more at your current real-time banking activity, your cash flow, looking forward, not just back.
Exactly. Which leads us to, I think, a pretty provocative final thought for everyone listening. If the biggest banks in the country are now successfully lending millions, maybe billions, based primarily on whether you manage your checking account responsibly, what does that tell us about the future? How important will that traditional FICO score be for everyday financial needs down the road?
Yeah, should we maybe start thinking about our basic bank account, our ability to show stable cash flow as being, well, a core part of our credit profile now, almost as important as the old score?
It definitely feels like the landscape is shifting towards valuing current stability alongside past history. Something to really think about.
Definitely something to mull over. Thanks for taking this deep dive with us today.